of this afterwards, and we'll email it to you. And then there's also a Q&A box. So if anybody has any questions during the presentation, go ahead and type those questions in, and Kelly will be monitoring them, and she'll interrupt me, and we'll try to answer them during the webinar. So everybody, welcome. Today we're talking about tax planning and your retirement. And this is Summit Financial Advisors. Myself and Kelly will be talking today. I'm Glenelle Jordan, a lot of you know me, and my partner, Kelly Tom. Every month we do webinars on different topics that are valuable to you guys. And we bring on guest speakers every other month. So next month we have an estate planning attorney coming on, and look out for that email on the upcoming webinar. And it's usually always on the third Tuesday of every month from 11:30 to 12:15. And we will be done at 12:15 sharp today. We'll do our best to be done at 12:15 sharp. Okay. So today what we're going to talk about, I'm going to be talking about kind of a current tax situation now, talking about how taxes work so we can get a base understanding. And then Kelly will be talking about different strategies to manage tax liability. So a little bit about our federal income tax system is it's a progressive system. And what that means is we have marginal tax rate increases as your income increases. And I'll go over what that means to you. It is a voluntary reporting, but funny enough, that doesn't mean it's optional. It just means that we are each responsible for filing our own taxes, calculating them, and paying them. And while everybody complains about taxes, surprisingly, not everybody actually pays them. The top 50% of federal income tax filers actually pay 97% of total taxes. And the top 10% of tax filers pay 70% of our federal taxes. And that top 10%, what does that mean? If you're making $145,000 in adjusted gross income, you are in the top 10%. So tax laws are constantly changing. In the last few years, we've seen a lot of changes, and a lot of it's due to new administrations. You may be on this webinar today because a lot of the new tax laws that have recently passed just in the past 2 to 3 years. And so we'll be talking a bit about those. So the first one that we'll be talking about is the Tax Cut and Jobs Act. So this was the big piece of legislation that was passed the first year that Trump was in office. So it was signed into law at the end of 2017 and became effective at the beginning of 2018. And this law was a $1.5 trillion package, and it had really large changes for both businesses and individuals. Most of the business tax laws were permanent changes, whereas the individual tax laws are actually set to revert back to old tax laws at the end of 2025, unless Congress decides to make those permanent. So it'll be interesting to see if that happens and what will happen going forward. Then there was the Secure Act, the Setting Every Community Up for Retirement Enhancement. And this tax law affected retirement accounts a lot, and also affected how employers could offer retirement plans to their employees. So I want to go over some of these because a lot of them probably do affect some of you on this webinar today. So it was enacted at the end of December 2019, beginning with the tax law becoming active beginning 2020. So the first really important one was the starting date for RMDs, also known as required minimum distributions. And so what RMDs are if you have a retirement account, an IRA, 401k, something like that, and you reach the age of 70 and a half, previously the IRS said you have to start taking money out of that account. And if you didn't, you were heavily penalized. So everybody does take money out so that they aren't penalized. And it's a small amount, and year over year it gets larger and larger. And the reason this exists is because the IRS is literally has been waiting to collect your tax revenue from these accounts your entire life. And so that's why they say you have to start taking it out. So that actually increased that age, and it used to be 70 and a half. Now it's 72. So if you are not yet 72, you don't have to start taking it. So that was one major change. They also eliminated the age at which you couldn't contribute anymore. So it used to be after 70 and a half, you couldn't contribute. Now, as long as you have earned income, which means you're working and creating income from that work, you can contribute to an IRA and there is no age limit anymore. Another one is the medical expense deduction. So it used to be 10%, now it's 7.5%. What this means is that if you have, large medical expenses in a given year, you can deduct them if they are over, you can deduct the amount that is over 7.5% of your adjusted gross income. For example, your adjusted gross income is $100,000 to keep the numbers easy. You have some sort of surgery that, for example, let's say it's $10,000 it costs you out of pocket. You can deduct the amount that is over 7.5%. So the amount that would be over 7.5% would be $2,500. That's how much you can deduct. Another major one is the inherited IRAs or beneficiary IRAs. So it used to be that when somebody inherited an IRA that was not a spouse, because when a spouse inherits an IRA, they essentially rename that IRA in their own IRA's name. But if a non-spouse inherits, typically it's an adult child, they used to be able to stretch out how when they took withdrawals from it over their lifetime, over their own life expectancy table. And what that meant is the tax implication was relatively small because they only had to take a small amount every year. So now the new law says they can't stretch it out over their lifetime. Now instead, they have to take it out within 10 years of the passing of the original IRA owner. So what that means is that the tax implications could be a lot larger because there's a shorter amount of time in which to take the money. So you could take it out all in 1 year, you could take it out in 2 years, or you could spread it out over a 10-year period. So this has created a change in some planning strategies. Maybe an idea is to take it out, before somebody passes away, so the tax implication to the beneficiaries is not as large. And then there's expanded plan participation, and this affects employers. So typically before, somebody had to be working 1,000 hours and at least be age 21 to participate in a 401k, and they reduced that to 500 hours. So those are some of the major changes that could affect you guys for your retirement account. So then there was the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. And this was enacted just last year in March 2020. And a lot of these provisions already expired. So some of the things they did, they expanded obviously a lot of unemployment benefits and tax relief to businesses. They provided a lot of us with refundable income tax credits and economic impact payments. One thing I want to note that might affect some of you or children or family is that, remember when some of us got our payments, and you would get it based upon how many people were in your household, and even if you had dependents, you could get paid based on those dependents. So if your family situation changed in the year, or if maybe you didn't get your payments for some reason, when you file your taxes, there is a checkbox where you will say, how many people are in your household, dependents, so on and so forth, and you will be able to get the money that you were supposed to get. For example, some of you might know that I recently had a child 10 days before the end of the year. Just my luck, because my CPA told me he said, you know, you get to put in how many dependents you had last year, and you actually will get the money that you are owed for having a dependent. So keep that in mind, that you will get the money if you didn't get it, and pass that information on to your friends and relatives. Another change from the CARE Act is they suspended RMDs. So if you were required to take an RMD last year, you didn't have to. So you could have let it go until next year. Now, taking IRA distributions, this was a big one. So if you're someone you know took IRA distributions last year and they were under 59 and a half, they actually, the 10% penalty was waived if it was due to a coronavirus, you know, related implication. You could take up to $100,000 without paying that penalty. Still, however, have to pay income taxes. And one of the major benefits is that distribution can be spread out. The taxes can be spread out over a 3-year period. So if somebody took out $100,000, they didn't have to pay taxes on the full $100,000 last year. So they could spread it out and maybe say pay $30,000 one year, $30,000 the next year, and then, you know, $40,000 the year after that. And then we are allowed to also repay them back into the plan as well. So I did have a couple clients that utilized that benefit. A couple other small things is the loan limit in 401k plans increased. The repayments were delayed by a year, and then federal student loans had an automatic payment suspension on them as well. I see there's some Q&As. Can you include medical premiums paid as a medical expense deduction? That I'm not, Kelly, maybe you could answer that. I'm not sure about that.
I couldn't see the chat question.
Oh, he said, can you include medical premiums paid as a medical expense tax deduction?
That's a good question. We'll get back to you on that.
Okay. Okay, so now let's talk about the different types of taxes there are. We'll be talking about ordinary income. We'll be talking about capital gains and qualified dividends, net investment income tax, alternative minimum tax, and then the difference in standard and itemized deductions. Okay, so ordinary income, what is it? Wages, interest, rents, royalties, business income, gambling winnings, and the taxable portion of Social Security benefits. And so what tax you paid is based on 7 different marginal tax brackets, which is determined by your taxable income. So in the Tax Cut and Jobs Act, 5 of these brackets were reduced, 2 of them remained the same. So the 10% bracket remained the same, the 35% bracket remained the same. All of the rest were reduced. Again, these are set to repeal back to the old laws in 2025, or I'm sorry, at the end of 2025, starting in 2026. Okay, what is the difference between marginal tax rate versus effective tax rate? This is an important concept to understand. So marginal tax rate is the tax rate on your next dollar of income. So the more money you make, then the higher the tax rate will be on the following dollar, but not on all the dollars. And so I'll explain how that works. Whereas effective tax rate is actually the tax amount that you've paid on your taxable income. So let's go through an example. Let's say you are a single filer with $50,000 in taxable income. That would put you in the 22% tax bracket, but that does not mean you're paying 22% in taxes. So what that means is your first $9,950 of income is taxed at the 10% bracket. That's $995. The following $30,575 is taxed at the next bracket, which is 12% of $3,669. And then the next group of income up to the $50,000, which is $9,475, is then taxed at 22%. at $2,084. So when you add those all up, the total tax paid was $6,748. So when we divide that by your taxable income of $50,000, your actual effective tax rate is only 13.5%. So that's what you pay, but we say you're in the 22% marginal income tax bracket because that's the highest tax rate applied to that chunk of income. Looking at it graphically, there's a couple of important numbers that we can see here, and this is when the tax rate jumps significantly. So you can see the tax rate from 12 to 22 happens at the $81,000 level. This is for married filing jointly. And the next big jump is an 8% jump from 24 to 32%. And that happens at the $329,850 level. So we covered ordinary income. Now we want to talk about, investment income, or taxes on investment income, or when you sell an investment like a stock or bond, what kind of taxes you have to pay on that. And those are called capital gains. So there's different types of capital gains. There's short-term and then there's long-term. So a short-term capital gain is defined as an investment that you held for 1 year or less. If you held an investment for 1 year or less and you sold it within that time and there is a gain, then you pay taxes at ordinary income tax rates. So you don't get preferential tax treatment if it's sold within a year. So then we go back to those old rates that we just talked about. However, the preferential tax treatment comes when it's a long-term capital gain. And those are for investments that were held over a year. And those get the special tax rates of either 0, 15, or 20%. Also, qualified dividends are also taxed at these same rates. And the rate that applies is based on your income, not your tax bracket. And I'll show you what that means. So if we look at married filing jointly, the tax rate on your long-term gains depends on your level of income. So if you are making up to $80,800, the tax rate is actually 0% on all long-term gains. Now, if you're making between $80,000 and $501,000, then you are jumped into the 15% tax rate on long-term gains. And then over $501,000, it's 20%. But once again, if it's a short-term gain, then it goes back to ordinary income tax rates. So when we laid the long-term gains chart with the ordinary income chart, what we can see here is that the first big jump happens at that $80,000 level. So this might, you might want to do some planning around this. So if you are in this $80,000 level, you might want to sell a long-term asset at this time. Or if you're not, but if you think you will be in the future, then you might want to hold on to it during a year in which you might be under that $80,000 threshold. Okay, now we're going to just touch real fast on a net investment income tax. It's an additional 3.8% on investments. So not wages and not income from retirement accounts or employer-sponsored retirement plans. So it's on investments, and it applies to high income earners. So if you're single, earning $200,000, over $200,000, if you're married, filing jointly, earning over $250,000, then there is an additional 3.8% net investment income tax. And then there's the alternative minimum tax, which also, acronym AMT, which also, the purpose of it is supposed to make sure that high income earners pay their fair share of taxes. But it has affected some kind of medium income earners as well. So the tax laws, it didn't actually repeal AMT, but what it did is it raised the exemption amounts and phase out thresholds. So now if you're married filing jointly, It doesn't start to affect you unless you're making close to $1 million married filing jointly, or about $500,000 as a single filer. So it's a lot less likely to affect people until the end of 2025 than it has in the past. So that is good news, and it'll be interesting to see if Congress makes that permanent going forward. Okay, now standard deductions and itemized deductions. So the standard deduction had been doubled after the passage of the Tax Cuts and Jobs Act. So it went to, if you're single, it went to $12,550. Married filing jointly went to $24,000. So sounds like good news, but the personal exemptions were eliminated. So previously, you could take a personal exemption for every person in your household. This was $4,050. This would apply to children as well. But personal exemptions are not allowed anymore. And it was kind of replaced with doubling the standard deduction. And then there's actually an additional standard deduction if you're over the age of 65. So I want to show you what that means by removing that personal exemption. So in 2017, a married couple with no children, they take their standard deductions, their personal exemptions, because two people, they would have $20,800 in deductions. Now with the new law, they doubled that standard deductions, but they get no personal exemptions. So they have a larger deduction. So with the new law, they actually paid less in taxes. So that really worked for them. However, if you had children, let's say we have an example, married couple with 3 children. So previously they'd get that regular standard deduction, and now they get 5 personal exemptions because they have the 3 kids and then the husband and wife, so 5 people. So their total deductions will be $32,000. But now with the elimination of the personal exemption, they can't take any. All they get is those standard deductions on husband and wife. So for this family, because they have children, they actually are paying more taxes under the new tax law. So not everybody is paying less taxes, even though the tax rates went down and the standard deduction was doubled. Actually, my sister-in-law, they have, hold your breath, 5 children and husband and wife. So that's 7 people in a household. So they really relied on those personal exemptions, and now they are paying quite a bit more taxes under the new tax law. And another kind of nice thing was the itemized deductions. There's no limit anymore. There used to be a limit on itemized deductions for high income filers. That was eliminated. There's no limit. The threshold for medical and dental expenses was permanently reduced to 7.5%. Like I said, it was temporary, 7.5%. Now it's permanently 7.5%. And then the deductibility for charitable contributions during the Tax Cut and Jobs Act was raised from 50 to 60, but the CARES Act increased that just last year for 100% of adjusted gross income. And now everybody is allowed in 2020 to do a $300 cash donation. And if you're a joint filer, it's $600 cash donation to charitable organizations, even if you don't itemize your taxes. So that's something you should take advantage of. And let me say real quickly, we're not tax professionals. Kelly and I both use CPAs, but this is something that you can at least be aware of and talk to your CPA about. I'm sure everybody here has heard about the changes to home mortgage interest. Before the Tax Cut and Jobs Act, you could deduct up to $1 million in acquisition debt and $100,000 in home equity debt. Now it's $750,000 in acquisition debt and not home equity debt, unless that home equity debt was used to buy, build, or improve your residence. So you can't take a home equity debt to pay for a car, kids' education, so on and so forth. But if it was used to buy, build, or improve a home, it's still deductible. So it's just a lower amount, $750,000. If you bought a house before the Tax Cut and Jobs Act and the mortgage is higher than $750,000, you're grandfathered in. And then state and local taxes, so those were capped. So not good news in high tax states because it's capped at $10,000 in deductions. So some of the high tax states like California, where their property taxes are really high, this hurt a lot of the homeowners there. Couple other changes: the Affordable Care Act, the requirement to have health insurance or you're penalized, so that was removed in 2019. The estate and gift tax has doubled to 11.7 million per person. So for a couple, it's now 23 million. It's very high now. Alimony is no longer deductible, as well as the income received from alimony is not taxable. And moving expense deductions for job-related moves are not deductible either unless you're armed service. So just some takeaways from what I talked about is marginal tax rates are low today, but very likely they could be changed by a new administration. Currently, the tax laws are scheduled to go back to the old tax laws in 2026, and then pay close attention to your taxable income threshold amounts as you're making decisions throughout the year. Okay, Kelly, I'm going to make you the host, and you can talk to us about strategies. There you go.
Okay. Let me just make it bigger. Okay, so we're going to be talking about, now that we understand how taxes work, how we can, sorry, I'm trying to get to the bottom of my screen. Hold on. I'll go this way. All right, the Zoom thing is blocking my, there we go. Okay. We're going to be talking about how you can manage your tax liability. Okay, when you're retired, your income is going to be coming from 3 main sources: your tax advantage accounts, your taxable, your tax-free, and then Social Security, and if you're lucky, a pension. So in retirement, it makes sense to plan, or actually now, I'm sorry, to plan where to have your different investments allocated. For example, it makes sense to have accounts that are going to give you dividend-paying stocks, index funds, municipals, and taxable accounts. And then if you're going to have taxable bonds or stocks that generate short-term gains, then it would probably make sense to put it into tax-free accounts. And so by arranging to have your investments in a mix of these type of buckets, it will give you the most flexibility to stay under some of the limits as far as Medicare premiums, how much of your Social Security is taxed, and your ordinary income tax bracket. So we'll get into that. Okay. So employer sponsor plans, IRA plans. So these are a lot of us have a bulk of our money here, money that we got the tax deduction on upfront. Keep in mind though, when you withdraw it, everything is going to be taxable at your ordinary income tax bracket. You'll want to keep it in to at least age 59.5. If you take it out sooner, then you'll face a 10% penalty. And there's special tax rules for employer stock, which we won't get into, but that's called net unrealized appreciation. So if you have that, certain ways you can take that out to get the lower favorable long-term capital gain rates. Keep in mind that money in your 401k IRA, it's all subject to the required minimum distribution, where you're forced to take money out. So how does that work? If you have money in a traditional IRA, traditional 401k, so money that you got a tax deduction on upfront, the government's saying, hey, I gave you the deduction, and all these years I gave you tax deferral. I want to collect my taxes. And so once you're 72, they just changed it. It was 70.5. So if you're 7.5 prior to 2020, then it's still, you fall under that category. But if you're after that, then you must start at age 72. And they're saying, hey, you must take out a certain percentage of your account and pay your taxes on it. And so for your first year, you can actually delay it 1 more year and take it out up until April of the following year. But if you do that, you're going to have to take out 2, right, to satisfy the previous year and that current year. If you do not take it out, then you're going to have to pay a hefty penalty of 50%. And so how it's calculated is they have a life expectancy table, and What they do is they total up, when I say they, is whoever has your money invested, whatever investment company, they're going to figure out your life expectancy factor based off of your age and let you know this is a dollar amount you have to take out from your account. And so the nice thing though about it is you don't, let's say you have you have a 1 401k and 2 IRAs. You do not have to take out a piece from here, piece from here, piece from here. You can total up, let's say total you have to take out 10,000. You can take out all 10,000 from one account, or you can take it out from 2 or 3, whatever you want to do, but you have that flexibility. So that also helps with your planning to see maybe depending on where your money's invested, this might be the best account to take it out of right now. Let these ones grow, depending how those work. And so they have a life expectancy factor, and it increases the amount you have to withdraw increases as you get older, because the goal is the IRS wants to collect all their taxes. So here's an example: 72-year-old, if they have an account balance of 500,000, they would have to take out about 18,000 for that year. Comes out to about 4%. Roth accounts, on the other hand, this is money that you may have invested and you put it in with after-tax money. So you did not get a tax deduction up front. As it grows, all of your earnings are tax deferred, so you're not getting a 1099. And when you withdraw it, it's federally tax-free. Huge, huge benefit. To avoid the penalties, you must have it open for at least 5 years, be over age 59 and a half. Or if you have a disability or a first-time home buyer, then you can take it out without penalty. Roth IRAs, they're not subject to required minimum distributions because you already paid the taxes on it, so they really don't care. So this is kind of nice. So some people, because I have a lot of retired clients and they're like, I don't want to withdraw from my IRAs. I don't want to pay the taxes, and nor do I need the money right now. But I'm like, sorry, you have to, that's just the way it is. So Roths are kind of nice for those people who, they want to have their money growing. Well, one is maybe, they see the government printing so much money right now. They're kind of concerned, like what, they must have to maybe raise taxes in the future to make up for this, or seeing that we're in a historically low tax rate environment, maybe taxes are higher, or they don't think they're going to be in a lower, maybe their income might be similar to now, or even more in retirement. So Roth is a nice way to create tax-free money that you don't have to take out only when you want to, that comes out tax-free. If you have a Roth 401k though, those are subject to RMDs. So once you're not working. So what some people do is you could roll it into a Roth IRA. It's still subject to that 5-year rule, but at least that way, then you won't have to worry about the RMDs. So Roth conversion, you might have heard this, it's becoming talked about a lot more just because people want to avoid taxes. So one thing you can do is if you have a 401k traditional IRA that you want to make into a Roth, you can convert it, but you'd have to pay income taxes on that amount converted. You do not have to convert the whole amount. You can do some of it if you want to hedge yourself a little bit. Let's say you have the majority of your money in traditional 401k money, and you want to just have some in Roth just for some flexibility, some tax-free money, you can convert some. Just keep in mind the amount you convert gets added to your ordinary income taxes, right? So you want to make sure it doesn't push you into a higher tax bracket or anything. And then if you have non-deductible IRA as well as regular deductible IRA, then they do it proportionately, which we can talk about offline. Once converted, then that's Roth money that grows tax deferred and comes out tax-free, and it's irreversible. Annuities are another plan that has some favorable tax benefits. You can put money in either pre-tax IRA money or even after-tax money, and all the earnings grow tax deferred. And when you withdraw it, only the earnings, well, depends. If it's non-retirement money, only the earnings are taxable. Once you get into cost basis, and it's not taxable. And so the earnings come out first. So that's, some people do it that way just because let's say they know they're going to have to take out their RMDs in the future. And so they rather start paying taxes on some of the things they can now. That is one way. Or some people, they want to spread out their taxes. So with an annuity, you can annuitize it, and then part of it comes out earnings, part of it return of principal. Similar to the retirement plans, that there's a 10% penalty if you withdraw it before age 59 and a half. But many people utilize annuities if they want to get a lifetime income stream, kind of like a pension, and they don't have a pension at work, then this is a great alternative. Tax-exempt bonds, some people say, hey, what can I invest in that won't be taxed on? So municipal bonds, the interests are exempt from federal income tax. If you get a bond from the Treasury, the US government, then it's exempt from state and local tax, but not federal tax. If you get a municipal bond issued in the state you live in, say the Hawaiian tax-free bond or whatever it is, issued in Hawaii, and you live in Hawaii, then it could be federal and state tax-free. Keep in mind though, the tax-exempt interest is included in the formula for calculating your Social Security taxation. And I'll show you an example in a bit. Keep in mind though, so tax-exempt bonds, they're nice because the interest is potentially tax-free, but the interest typically is lower than a regular taxable bond. So you'd want to make sure it makes sense for you. So for example, let's say a tax-exempt bond is paying 2%, but a regular taxable bond is paying 4%. You'd want to make sure that, is it worth saving on some of the taxes to get 2% lower interest a year? So those are other things to look at, which we can help with. Okay, how are your Social Security benefits taxed? And so Social Security, they have not updated this table in, I think, since its existence. And that's why these numbers are not, haven't been adjusted. And so married filing jointly, if your income, let's look at what they count as income. So your regular adjusted gross income, then they add back the tax-exempt interest from the municipal bonds we just talked about, and then they count in half of your Social Security benefits. That's your combined income. So if your combined income is less than $32,000 a year, then your Social Security benefits are not taxed. If it falls in between here, then half of it is. If it falls over $44,000, then up to 85% of it is taxable. So some planning here for people who are in this bracket. Let's look at an example. So let's look at a couple 1 and 2. They have the same earnings basically. They're both getting $5,000 from interest from CDs, $10,000 from stock, dividend income, $5,000 tax-free bond interest. They're both taking out $25,000 a year from their IRAs, and their Social Security benefits $22,000. But look, so the total income they're receiving is $67,000. But for purposes of determining how much of Social Security benefits are taxed, they only count half of the Social Security benefits, right? So that's only $11,000 is counted. So the amount that's counted is $56,000. The 67 minus 11, so $56,000 is counted. Because they're over that threshold, right? This $44,000 threshold, then their benefits will be up to 85% tax. Now in this scenario, couple 2, they're withdrawing from a Roth IRA, and so this $25,000 is tax-free, so it's not counted in their total income for Social Security purposes. Minus out the half of Social Security, so their income is $31,000, and now they fall under this category, under $32,000. So their Social Security is not taxed. Income also affects Medicare premiums. For most people, Part A, there's no premium because we're paying into it through our FICA taxes during our working years. But Part B is the part that we pay into. And so it starts off at $148.50. So if your single modified adjusted gross income is $88,000 or less, or a married filing joint, $176,000 or less, then each spouse's or each person's premium is $148.50 a month. But as your income gets higher, then your premium gets higher, and it can be as high as $505,000. And so what they do is they look at your income 2 years prior. So let's say you have to pay for your 65 this year, and you have to start paying for Medicare. They look at your income from 2019 to see where you fall under. But let's say you were working 2019 and you just retired, and your actual income now is a lot less. You can actually file a form with the Medicare office and say, hey, that was my working income. My income is less, please adjust. and then they could adjust your premium to the lower amount. So now that we talked about things that factor in, right, how things you can do to be aware of to lower taxes, things to take into consideration is when to start claiming Social Security, when to start withdrawing from your retirement accounts, and then the impact of RMDs and sale of appreciated assets. As Gona mentioned, with if you're let's say you're inheriting a retirement account, if it's from a spouse, it's very flexible. You can pretty much put that account in your own name and continue on. And if you're over 72, you can take out the RMDs over your lifetime. But if it's going to a non-spouse, let's say you're inheriting it from a parent, then you only have 10 years now to withdraw. So let's say that I have a nice 401k, let's call it $1 million, and you inherit it, and that's all taxable money, right? Previously, they allowed you to take that out over your lifetime to spread out the taxes. Now it's 10 years. So you'd have to take out that $1 million within 10 years. So keep that in mind, because that could be a huge tax burden for you down the future. And so some planning there too. Maybe if parents are in a lower tax bracket than you, maybe it makes sense for them to start withdrawing more to pay taxes on that money and, you know, make that after tax money. Or same thing, if you have money that you're passing on to your kids, keep those things in mind. Other ways that you can save on taxes is considering a health savings account, HSA. These are only eligible, you're eligible if you have, or if you're enrolled in a high deductible health plan. So if you have that, then you can do an HSA where you put money in pre-tax, the earnings are tax deferred. Unused funds that you don't use can go over to them next year, so you don't lose out on it. And if used for qualified medical expenses, it comes out tax-free. So nice benefit. Has to be used for medical expenses until you're age 65. After that, you can use it for whatever you want to use it for. The more common one that many employers offer is a flexible spending account, FSA. So this one, there's two. The health one, you can use it for any health-related thing. So you put money in pre-tax as well. Usually your employer takes it out of your paycheck. And you can use it for deductibles, co-pays, prescription drugs, Band-Aids, whatever may come up. It's a nice way to use money, I guess get a tax deduction, and it's not subject to federal Social Security taxes. The other one is dependent care. This is huge for us since our daughter goes to daycare right now. We put in the maximum, so we can save on that there. And the maximum is $5,000. And same thing, money goes in pre-tax, and then it comes out tax-free to use for whatever you want to use it for. So highly encourage you to take advantage of these. Most times it expires at the end of the year. Many companies though, they have a grace period. It might be 3 months or 6 months, or it all depends on the company. So make sure you check and understand it, because once that grace period or the term expires, then you lose out on it. So you would want to budget each year how much you think you're going to spend. Qualified charitable distribution. So if you do not itemize, but you want to donate to charity and get the full tax benefit, and you're over 70.5, you can utilize what's called a qualified charitable distribution. So what it is let's say you have an IRA and you want to make a donation. You have the IRA company send that money directly to the charity, and that amount will not be taxable to you. Or another situation, let's say you're over 72 and you have to take out your RMD, but you don't need the money, nor do you want to pay taxes on it. You can send that money to the charity. It'll satisfy your RMD, and you also won't have to pay taxes on that money. And you can do up to $100,000 a year on that. And you don't have to send all your RMD money. Maybe you just want to do some, because you always do something to a charity. This would be a good place to do it, to take advantage of the full deduction if you don't itemize. Some people, they have their 401k, they have their IRA, but they don't want to pay taxes. Even when they're 72 on their RMDs, they're like, I don't want to pay taxes. You can actually do what's called a QLAC, a qualified longevity annuity contract, with an insurance company, and you can actually defer that money. Like, you don't have to take the RMD from that money until you're 85. It's structured a certain way But once you're 85, then you have to start taking withdrawals. You can only do up to 25% of your total retirement nest egg into a QLAC, up to 135,000. Okay, so I know we covered a lot. Oh, perfect, we're right on time. Yeah, we know there's a lot of information. Don't worry about having memorized everything. That's what we're here for, to help you every step of the way. And we like to show this slide because this is realistically what it is. You can try to plan to do it yourself. You could procrastinate and not do anything, or we can help you. And so we know which is the worst option, but we also know what might be an easier option. So if you have any questions, want some advice, second opinion, anything, please feel free to reach out to us. Thank you for joining us. Is there any more questions? I didn't look at it.
No, that was it.
Okay. Okay. Great. Thanks, everybody. Hope you have a great day. Stay tuned for our next emails about the next workshop. Have a good day.
Bye, everyone. Thank you.